Welcome to the Corporate Treasury 101 podcast. This episode is the full uninterrupted episode with Daniel Sanches, Engineering Director and Bitcoin enthusiast. In this episode, we don't go into the technical details of Bitcoin and the blockchain and how it works. You can find out more about that in the show notes below. Instead, expect to learn why Bitcoin is a reset on the layers of money, why that solves the issues with the money system today, and practical applications of Bitcoin in corporate treasury such as hedging and cash pooling. As always, please rate us on your podcast app and go follow us on Instagram at Corporate Treasury 101, where we would love a DM from you to understand more about the kind of topics you want to learn more about here on the podcast. And with that, on with the episode. So, Daniel, the world of money is changing overall, right? And here at Corporate Treasury 101, we talk a lot about money, cash, in a lot of sense. And when we talk about cash, we talk about euros and dollars and whatnot and GBP. There's this new form of cash or new form of exchange of value, which has emerged over the last 10 years or so, and certainly become mainstream over the last 5 years, which is Bitcoin, right? What is Bitcoin?
So, first of all, I'm not an expert. Yes, so everything that you'll hear is based on what I've read, what I've heard, what I've gone into over the past, I would say, 2.5 years. Yes, so Bitcoin is, and I'd like to keep Bitcoin separately from cryptocurrencies because Bitcoin is really what my passion goes into. Okay, the way I see Bitcoin today is it's a pure form of value. Okay, so hence a bit the digital gold element, right? Why do I see it as the pure form of value? Once, because it's since the beginning of Bitcoin, it has had some adoption, right? It has adoption from a retail point of view. So it started with a few individuals, it moved into more individuals, famous people, and now even to a certain extent, some specific institutions, which has allowed it to have a specific value in today's currency, in fiat currency, dollars or euros. So that's why Bitcoin is a pure form of value. It's more than just digital gold, right? Why do I say this? I say this, one is because anyone can buy and hold it, right? Because each Bitcoin is composed of 100 million subunits called satoshis. So if you want today, you can go and you can buy €1, 10 cents, $10 worth of Bitcoin, and anyone can do it, right? Anyone, almost anyone, as long as you have the right digital acumen to know where to buy it and how to get access to it, right? And the beauty of it is you can actually do it and you can hold it without having to pay any monthly fees. You don't have to open a bank account. You don't have to share your identity with banks, etc. Right? So it's or even having the risk of having it confiscated by anyone if you know how to do it in the right way. Right? So I think that's for me is point number one when it comes to value. The second part is it's a counterparty-free asset. If you buy your Bitcoin and you own it or you hold it, right? Whether it's cold storage or you print out your receipt or whatever it is, you have no risk of losing it except for yourself. So you don't have to rely on government, which in the end is the ones who provide the value to our fiat currency. You don't have to rely on banks not going bankrupt. You don't have to rely on the integrity of a safe, of keeping your gold or money inside it, right? And then the third element of it, why I call it a pure value, is the resiliency of Bitcoin, right? The fact that today you have around 50,000 nodes across the world, which keep the full history or the full ledger of Bitcoin since the very beginning, which basically keep it safe, right? Keep it safe, keep it consistent, keep it real. That's my definition and the value of what I see from Bitcoin.
Very good. So we want to steer a little bit away from the technical aspects of distributed ledger, etc. There's plenty of podcasts out there on that, and we don't want to go that. This is Corporate Treasury 101. We want to talk about really Bitcoin as a store of value. Now, you called it digital gold, or more than digital gold. Where does that comparison come from to gold? A lot of people say Bitcoin is digital gold. Why are we comparing it to gold? And what's the role or the historic role of gold as cash?
Okay, so going back into that, right? So once again, keep on making the disclaimer. I'm no expert, yes. So all of this comes through what I've read, yes. But it comes through what the layers of money are, right? And I think if people really want to understand the details, there's the great book out there, Layered Money by Nick Bhatia. I would recommend to read it if this really entices you.
We'll put it in the show notes.
That would be great. That would be great, right? So let's talk about gold first, right? So even before gold, the way that the economy would run hundreds, thousands of years ago was barter, right? So people would negotiate and exchange services for services, goods for services, etc. That's not very scalable. That's not very efficient. It only allowed to get to a certain level of development, right? And so when it came to moving from one place to the other, or when it came to wanting to grow, wanting to be ambitious, wanting to be rich, wanting to develop, wanting to invest, there was no means of doing it, right? So the rate of evolution was very, very slow, right? Then came gold, or better, gold coins. So a precious metal, a metal that was rare, a metal that was could not be affected by weather or external conditions, right? So what happened? Kingdoms, empires, they all made use of gold to build what was called currency at that point in time, which was gold coins, right? So hence the basis where gold comes in terms of the first true form of value that was tangible, fungible, divisible, could be transported, and could be easily exchanged, whether it be for other gold, whether it be for services or for goods, right? So that's where the first truth of value come from. And this became the first layer money ever made, right? As humanity evolved, as we got more ambitious and we tried to expand, right? We've all heard about trading houses and banks and the Venetian houses giving letters of credit for the people who wanted to travel or trade, right? So this is when actually the first signs of transitioning from gold, or transforming the value of gold into a note that could be exchanged for the same value somewhere else, started to emerge. Okay, these trading houses actually became very, very powerful, right? Because they became the center of where all commerce was coming through, where all gold or all notes were being transacted. So obviously, what do governments, what do kings, what do emperors want to do? So they want to take over control, right? So what actually happened is that governments took over this first, let's call it this emission of notes, took over the custody of precious metals, right? And started making their own currency, right? So that's where gold-backed currency started to come in from, right? And then basically these gold-backed currency became what's called a second layer of money. Once government started to take control of this, right? And they took control between that first layer, right? So the gold, and the second layer, it was a super important step because it was the first moment in human history where whatever value you wanted to exchange, the government had their fingers in it, the government or the kingdom or the empire, right? You could still barter, but that would not make you rich. You could still barter, but that would not give you money to invest or money to grow your business, right? So it really came into, it really was what created and brought the government into our lives in every single point, right? Because money in the end is what we earn, it's what we spend, it's what we spend most of the time doing, right?
Why is that a problem? Because it sounds like
I'm not saying it's a problem.
Okay.
Right? I'm not saying it's a problem as soon as it started, right?
Okay.
As long as it was gold backed, that was perfectly fine, right?
Okay.
Now, since the government took over, right, there's a point in time in which the number of layers started to increase, right? So what happened is
So at this point we're at 2 layers.
This point there are 2 layers, and we will remain at 2 layers, right? Because then it's very difficult to talk about the different layers that actually exist. But the second point at which it comes is these trading houses, these initial banks that started, they still wanted to do business, right? So the way to do business was they actually started taking the notes of credit or the bills of exchange or the notes of debt from those empires, those kingdoms, those governments that were emitted by those national banks, right? they started in taking money from, or the fiat money from customers, from consumers, right?
Yeah.
And so this started making the distance in between what you and I spend day to day and what would have been a gold-backed currency start to become bigger and bigger. Okay. Those number of levels increased.
Yes.
Right. What happens when that level of numbers when those levels increased? What happens when I give you 10 euros and you give Hussam 10 euros,
Yes.
and then Hussam then gives another person 8 euros, right? What's the trust of that last person going to make sure that, or what is the trust that I have that last person is going to pay all the way back up the chain, right? So the amount of risk that something breaks in that money chain increases.
Okay.
Right? Because in the end, you cannot count that every single banker will do the right thing. That every single banker, when I give them money to deposit, that they're not going to loan out more than what they should, right? That they're not going to steal all the money and run away to the Bahamas, right? So counterparty risk increases as the number of layers increased, right? So you had gold reserves kept in, let's call it the Bank of England, right? The Bank of England then emits the notes to the government of England, which then issues debt, right? Which then can be bought by other banks, which can be used as collateral for then lending or borrowing, right? And so it cascades down as you go throughout the full system, right? So that increases counterparty risk. Then there is a pivotal moment when this happens, which is at a certain point in time. So I'm not even going to talk in terms of when we moved off the gold standard or not, but at a certain point in time, fractional reserve came into play. It actually became legal. What is fractional reserve? Fractional reserve means that if I deposit 100 euros into the bank is only obliged to keep 10 euros of it. They can actually use the remaining 90 euros to lend it off to someone. What does this do? This also increases the counterparty risk. It doesn't mean anything is going to happen. Nothing ever means anything is going to happen, right? But the amount of risk increases. Okay, so
until everyone goes to the bank to take out their
until
money,
everyone is until you have a bank run, right?
Yes.
And you can have a bank run for many reasons. Either the government says that they're not going to allow people to take money out of the bank, as simple as that, right? Or there's a currency devaluation or a series of things. So a lot of instances can trigger that. So why is Bitcoin called digital? Why is Bitcoin called digital gold, or why is it compared to digital gold? Is because, as I mentioned before earlier on, right? The distance in between Bitcoin and the person who owns it and the real Bitcoin is only as big as you want to make it, because you can hold it yourself. You do not have to rely on any counterparty risk. You can take the risk as much as you want, because you can put it on lending platforms, you can lend it to a friend, you can lend it to a friend's friend, right? So, but it depends purely on you, and you're not dependent on the fractional reserves that banks are entitled to. You're not dependent on the trust that the government has that it will repay its debt. You're not dependent on how much debt that government is going to continue to emit to pay for our social security, to pay for our health services, to pay for our roads. And so that's where the comparison comes from. Physical gold, so not the gold-backed system, but physical gold and Bitcoin.
Okay.
That's a long answer.
That's
It's a very,
that's
very
big
long
piece.
answer.
But so the interest of gold and government-backed currencies and money overall is also the value that you perceive out of it. The banknote that I have has value because I know I can use it in a system, right? How does Bitcoin work in that way? Because if it's not backed by anything, so the distance between you and the Bitcoin and the holder of the Bitcoin can be as big as you want or as small as you want, because you can hold it directly. But what's the value of it?
So there are two things. One, Bitcoin will not replace fiat money.
Okay.
Yeah, it's in the short term mean next 100 years. I think it's virtually impossible to
You heard it here
replace
first,
fiat
everyone.
currency. Sorry,
You heard it here first. It's not happening.
but that's not the intent of it, right? That's why the definition of Bitcoin being a true form of value is where I refer to, right? So you are right. So you cannot go exchange Bitcoin or Satoshis for a service or in any shop or most of the shops around it. But what you can do is you can exchange that Bitcoin for fiat money.
Okay.
right? So Bitcoin today is not a means of exchange for most of the current services, even though there's Lightning Network, but that's a whole episode just on it, right?
Okay.
But you can exchange it into fiat currency. You can have it as a store of value, right?
Mm-hmm.
I can decide to buy a Bitcoin today because I believe that with the way that government and public entities today deal with public expenditures, taxes, social security, etc., will keep on printing money. So I can believe that it's a way to keep my specific value from being debased.
Okay.
So what my belief is, today I buy it for 10,000. In 10 years, not 2 months, not 3 months, because there's always volatility in the system, but in 10 years, it will be worth more than the 10,000 I put today.
Okay.
Yeah. So gold went through all these layers, right? You had base gold, which was like the physical, shiny metal gold in coins. That went into being an intermediary stage that happened in history was individual banks, let's say, or traders or houses, you called them, started issuing certificates for those coins and said, hey, look, don't carry the coins around. Here's a certificate that shows that I will give you the coins, right? That eventually was like a Wild West system, which the government then took over and says, okay, forget everyone else's certificates. We're issuing our own certificate, which today we call fiat currency, right? Dollars, euros. At one point in time, in the original system, that was representative of $10 of gold, right?
Correct.
And so what you're saying is the comparison with Bitcoin and gold is Bitcoin isn't built off that gold reserve. It's its own value of currency, store of value, which is like holding gold coins, right? In a way.
Correct.
Because it's not like today you can print more and more notes not linked to gold, right? This is going off the gold standard, we call it. But so to hedge against that, you could have gold itself, or you can have a new store of value, which isn't dependent on gold, or cash, which is Bitcoin.
Exactly.
For example,
It's
as one value store of value.
It's a new asset class in the end.
Yeah.
It's a new value asset class. Yeah.
So going back to one of Guillaume's problems earlier, why is that a problem? The fact that the government has the control over fiat, not linked to gold anymore.
There are two reasons, right? Or two reasons. There might be a series of reasons. One is the supply of fiat-backed currency. You have no control in it. So it can be as much or as little as the government wants. You have no say in it, right?
We talked about this in our episode about inflation.
Exactly.
Actually.
And as you increase your supply, the unit value, the unit intrinsic value decreases, right? Inflation, right? If it decreases the supply, then the economic impacts of what that might have on economic growth, that's another different story, right? So you see it today, right? The rise in interest rates, the potential quantitative tightening, right, takes out liquidity from the market. Everything has a tendency to slow down. People become more conservative. From a fiat point of view, things will not necessarily lose value, but will not grow.
So you are taking out of your value system the counterparties, or at least as many counterparties as possible, to rely on one network instead.
Yes.
And this is all basically just counterparty risk. You don't want anybody to have a say into what the value you have is worth, nor to control it in a way.
What will say what the value is worth of whatever number of satoshis I hold is the market.
Satoshis? What is satoshis?
Satoshis are the sub elements of Bitcoin.
Okay.
Right. So one Bitcoin is 100 million satoshis. Satoshi Nakamoto is the supposedly creator of the Bitcoin protocol. Okay. So the value of the Bitcoin, the satoshis, will be dictated by the market, and in terms of fiat currency. Precisely because of what you mentioned before. Today, I cannot use Bitcoin to exchange it for anything else specifically.
Okay. That's very clear.
So Dan, you give a very good introduction on how Bitcoin is a store of value, right? And why it's been compared to gold in a lot of instances. And it's all about, as a new asset class, which I really like the way you said that, a new asset class, which is starting from layer one again in this layers of money that you described to us earlier, right? So you're closer to the original asset class, just like holding gold and exchanging gold, instead of using notes And we also discussed how the problem with using notes is that as you move away from gold-backed notes, which is moving away from the gold standard as commonly referred to, that what that means is the government or any party that controls those notes can influence the supply of those notes in the economy as and when they want, not linked to any specific layer one. So now fiat currency is just this layer without a bottom, almost, right? Which can be completely manipulated however it needs to be. So having another asset class which is linked to a layer one again has its own value. To me, that smells a lot like hedging, or the value of that smells a lot like you can use this asset class to hedge against these other asset classes which aren't as stable or aren't as rooted in something layer one. So how does that work? Where is that used today in the world, and where do you see the value in that for Bitcoin?
So used today in the world, I'm not able to tell you, right? Because there's a lot of companies out there who buy Bitcoin because of the belief that their value in fiat currency will go up. Also because they have very smart ways in how they issue Bitcoin-backed bonds, MicroStrategy, and then other companies like Block and Tesla who have done it maybe to kind of follow the road, but that's a different matter, right? But where does Bitcoin come in terms of hedging, right? You guys did a series of episodes where you talked about foreign exchange hedging, interest rate hedging. But what nobody talks about, and this might seem like a bit, how should I call it? I'm not looking for a doomsday reaction, right? But nobody talks about the financial system hedging, right? A strong reserve currency devaluation hedging, right? So Bitcoin could eventually be the source of that, right? As adoption grows, the value in fiat currency of a Bitcoin, of a Satoshi, will have the tendency to increase. Yeah. So even the slightest percentage of a corporate treasury or a corporate reserve being stashed away in Bitcoin could actually be a way to hedge against the devaluation of a reserve currency, whether it's the dollar, whether in Europe it's the euro, whether it's something else, right? Because as that currency debases, it would allow to absorb some of, not all of those shocks, but some of those shocks, right? Now, the beauty of it as well, from a hedging point of view, is that you don't need to go to a financial institution to do that hedging. You can do it by yourself, right? You get the Coinbase institution account, you buy your Bitcoin, you set up your cold storage. There are a lot of services to do that out there, but nothing in principle should stop the company from doing it by themselves, right? And you start, and you do not need to think about it. You don't pay monthly fees, you don't pay rates, you don't pay anything on it, and it's a simple hedge, right? Okay. So I see it really as a financial stability hedge versus a store of value from a company point of view in that part.
It's interesting because indeed, every time we've talked about most of our topics in this podcast, whether it be hedging, whether it be investments, there's always this middle party, right? There's always the bank, there's always the financial institution in the middle. We've always sort of joked about fees linked to that and everything like that in the past. But we never really talked about the risk of those financial institutions. We always say, but then you have a financial institution who guarantees the transaction. We talked about trade finance, for example. You can go to a financial institution when you're looking at the bonds market, the secondary markets, for example, right? But we say, then that's much safer and this and that. But I think it's also, from a privileged position living in Europe, thinking about European economics, thinking about American economics, we are used to stability. So we're used to these financial institutions being very safe. Whereas maybe you come from part of the world where that isn't the case, where you can't have as much trust in the financial institutions like we so candidly take advantage of and think it's just, banks safe. This could be a really good way to hedge against those intermediaries in the first place, right?
Indeed. I mean, there are examples of that. I mean, Venezuela has been one of the key adopters of Bitcoin. Argentina, the same thing. And what's the characteristic of those companies? Their underlying fiat currency is not stable, and that's what allows fortunate or sometimes even less fortunate people to be able to maintain their base value.
Because usually they would do that with dollars, right? Which is the global reserve currency, right? But actually, nowadays there's a lot of really interesting stuff on that about how, for example, inflation on the dollar doesn't hit the US, it hits all the other countries whom
who have dollar-based debt.
Dollar-based debt, indeed. So the US almost exports their inflation. So you also hedge against that. So because someone say, why would I buy Bitcoin if I'm Venezuela? Why would I not buy dollars?
Yeah.
But the dollars is still dependent on the US government being able to manipulate its supply of dollars in the world, right? And then you're still, let's say, exposed to that risk.
You're still exposed to that risk, and there's another thing, right? Is where are you going to get dollars from an ATM machine in Argentina?
Yeah,
right? So the limited amount of physical dollars is really, really limited. Number two, if you want to leave the country with $10,000, somebody's going to see that envelope with that stack of notes in your backpack, right? If you want to leave the country with Bitcoin, or if you even just want to send it, there are tons of ways in which you can do it incognito, really, without the supervision of anyone.
But going back to a corporate, if you're a corporation sitting in those countries with a very volatile fiat currency, you could hedge using dollars. Or if you also think, hey, look, I sit in Venezuela, the value of my dollar is going to, versus my base currency is going to change so much, I can also hedge using Bitcoin.
Bitcoin, indeed.
Very interesting.
So you hedge against the financial system or the counterparties of the financial system with Bitcoin. Now, what are the other uses that we could have in corporate treasury of Bitcoin?
There are two things. One of them is really financing, right?
Yeah.
So a lot of what you hear nowadays is about DeFi, decentralized finance, right?
Yes.
But even in cases of centralized finance, a lot of these new institutions coming in, nowadays they're actually taking in Bitcoin as collateral for lending.
Okay.
Right? The way a lot of these systems work, not all of them, but the way a lot of these systems work is that depending on the amount that you want to borrow, right, and depending on the interest rate that you want to pay, you will have to provide more or less Bitcoin as collateral.
Okay.
So what does this actually allow you to do is if a corporation has one Bitcoin in their corporate treasury, and they need a short-term liquidity injection to do a promotion, to do a project, whatever it is, right? Is nothing stops them from giving that Bitcoin as collateral.
Okay.
Right? So, which that institution still acknowledges that Bitcoin is yours, but they're taking custody of it, and they provide the liquidity to you. Right. Okay. Typically, the liquidity is provided in what is called stable coins, but it's US dollar equivalents. Nothing stops you from changing it to US dollars or into euros, right? But that gives you the liquidity you need in fiat currency to invest in right now. Now, obviously, you would not use that as collateral just to spend the money, because then you'll never see your Bitcoin back, right? But if a company has the intention to invest it in a project that will provide the adequate returns, it then does give it the adequate cash flows to, one, pay back the fiat value that it took as a loan, and within the due time, take back that Bitcoin or more with whatever the fiat value of that Bitcoin will be at that point in time.
And so exactly, that's the point. Bitcoin is the value of Bitcoin in fiat currency is quite volatile. So how do you use that as a collateral? Because at some point in time, maybe right now I'm giving a Bitcoin, I'm having a Bitcoin as a collateral to my debts, but maybe in 2 months, the value of the Bitcoin has totally changed, one way or the other, and the bank will say, look, now we will need you to have 2 Bitcoins in order to guarantee this loan that we made 2 months ago.
It can happen.
Okay.
It can happen, right? But when you look at, and that's why not all the platforms are the same, right? And that's why you need to be aware in terms of the amount of collateral or counterparty risk that you represent to the other individual, right? So most, at least what I've seen in practice, and I'm talking from a personal level, right? What I've seen in practice is you get lent a fraction of what you provide as collateral, which provides you the adequate buffer, right? So it's a good theoretical exercise, right, for a corporate treasury. Now, obviously, 1 Bitcoin today is worth whatever it is. That probably doesn't allow a big company to do a lot of business, right? But if you're a startup and you have 1 Bitcoin, it can maybe give you the $2,000 or $3,000 that you need to inject to make sure that you keep on getting the right levels of cash flow. So typically what you get lent out is significantly, it's a fraction of the collateral that you provide.
Okay.
And if you look in terms of giving collateral, there's one. If you have that Bitcoin stored, if that Bitcoin has been yours, in the end, you're not impacting overall. You're not impacting your cash flows. On the contrary, right?
Yeah.
You're not providing as collateral a cash flow producing asset. So if you're a big company, you're not giving a factory or a machine or your house where you have to live in, right? Or your offices, right? But you're providing a store value or a pure form of value that is not affecting your cash flows overall and is ideally giving you an instrument that can produce cash flows.
How so? How would it produce cash?
No,
So
the fiat value that you get or the fiat money that you get as borrowing is what ideally you should then have or invest into to create the cash flows, which will then allow you to pay back.
Okay. Yeah. So that's for financing.
To financing. The last one really is payments, right?
Okay.
Lightning. So Bitcoin network is known to be slow, right? And it's expensive from a transaction point of view. But there is a secure second layer called the Lightning Network, which has a significant amount of adoption. Big companies already use it today for certain payments. You find Amazon.
Really?
You find some movie. Yes, you find a lot of e-commerce which today actually use or accept Lightning Network for payment. So what's Lightning Network? Lightning Network is essentially it's a network of nodes that are coded to run a specific protocol or the so-called smart contracts, which what they can do is they allow a node or so a part of this network to actually hold third-party money or third-party Bitcoin in this case until a certain amount of conditions are affected. So what happens is you as a company, you can build a Lightning Network node where you put in one Bitcoin.
Yeah.
You can connect that node then to as many other nodes as you want to in the Lightning Network where you provide liquidity into those connections. Okay, so out of that one Bitcoin, imagine you say you establish 10 connections, you put 0.1 Bitcoin into each one of those connections. And basically, once that Bitcoin is put in there, it allows for you to transact with those nodes, right? That 0.1 Bitcoin. Okay. So effectively, what you're creating is you're creating a network of payments. Okay. These payments can be routed at the 10 to 20 to 30 to 40 satoshis per transaction. So if you take that out of 10 million, that's well below the 0.5% that Visa or MasterCard will make you pay. Okay. So this is how the Lightning Network is built. Okay. So how could a company use this eventually from a treasury point of view? So you guys have talked a lot about Hussam's Cafe, right? If Hussam ends up having 10 cafes across the whole world, right? When Hussam has the 10 cafes across the whole world and he has one central headquarters, right? He can actually set up Lightning nodes in all of those elements, right?
Okay.
You can actually put Bitcoin reserves into those specific channels. You can actually use those nodes to do your cash pooling. Why do you need to do it through a financial institution?
You listen,
right?
Daniel.
Why do you need to do that through a financial institution, right? You can do that through the Lightning Network for a fraction of the costs.
Okay.
And you can use that. You can do that with a click of a button. You can actually even automate it if you want to.
Okay.
The second part is once you have that set up in all your different cafes, Hussam, is as people gradually get their Lightning wallets into their mobile phones, they actually can start paying you in their satoshis.
Okay.
So that creates not only the fact that you can also receive and get paid into Bitcoin, which on a longer term could allow for value increase, right? But it really allows you to fully interconnect legal entities or different points of sale, whatever it is, completely separate from what Visa, MasterCard, or whatever other system is that you have today, where you pay 0.5, 1% fees. So there is potential behind it, but the point is two critical things. On all the 3 points that we mentioned, which is legislation, number one, which is not always easy to come by, and adoption.
So legislation, because you need the government to allow you to trade in Satoshis or Satoshis?
You need to understand how to treat those from a financial and a tax point of view.
Exactly.
Right?
Yeah.
Especially when it comes to capital gains, right? Especially you can use it as capital gains or capital losses, right? But how that framework today fits is, for me, as a humble individual, is not clear, right? But even everything that you hear from across the board is it's still in limbo, right?
So the value of that, for example, doing a cash pooling like this is twofold. One is the cheaper cost that you mentioned, right? And some of these, like the night network, maybe not the standard Bitcoin, but some other forms of Bitcoin, is cheaper and just as fast, if not faster. But time isn't typically one of the constraints nowadays from the traditional system. But it's also, like you said, versus the traditional system of Visa, MasterCard, etc., where tomorrow those systems go bust because they are companies at the end of the day, and companies fail all the time. You're not reliant on that, and your payment system doesn't get wiped overnight by Visa going bankrupt.
No, the other thing is, if you think about what we were talking in the beginning, counterparty risk, right? Is if you have a cafe in China and you have a cafe in Canada and another one in Saudi Arabia, the Lightning Network allows you to do that without having to go through probably a multiple of financial entities.
Because, I mean, when we did the cash pooling episode, we also talked about how usually you want to set that up within one bank, right?
Exactly.
So if you do have one in China, one in Canada, and one, you'd have to go to a really big bank, and maybe you're a small-time player for a bank of that size, and they're not going to give you great favorable terms. But doing it like this would help you do your cash pooling in a much more effective way.
And in one currency, how to say this actually? It's not a currency.
You can say it's one form of value.
One
form of value.
And so, just to come back on this payment, you will need any counterparty you are dealing with to be connected to one of those nodes. You cannot just have somebody come in and pay in Satoshis. You need him or her to have a node.
Exactly. And that's why I said, you don't need to have a node, right? They just need to have a simple Lightning wallet on their phone.
Okay.
And that wallet can be connected to any node whatsoever.
Okay.
Right? So having the node, what it allows you to do is you open up your own channels of payment. You can choose who you connect to. You can choose the fees of transaction across those nodes, right? But you as an individual, Guillaume, or you can have your own Lightning wallet where you keep your Satoshis and you can do the payments without having to run a node yourself.
Okay. That's super clear.
Business context, I imagine that could be interesting. You could set up, if you wanted to do this, if I'm a cafe, I could set up my own, let's say, payment system, right? I have an app for my cafe. Think Starbucks. So Starbucks today, they have a Starbucks app. Yep. What you do is you deposit cash into the Starbucks app, and then you continuously pay with the app instead of paying with cash. That could be set up on a crypto network, right? Or a Bitcoin Lightning network. Your
Lightning Network node automatically does that. If you want, you can issue a receipt, which comes with a QR code. Which it says the value and it says the node that this needs to be paid into. The individual who's coming in just scans it into their wallet and you get paid.
So what if the network goes down? Because we are saying, okay, we want to eliminate that risk of a counterparty within that chain of taking too much money or doing whatever with our money or going bankrupt so the bank cannot give you your deposits back. What if the Lightning or the Bitcoin network goes down? Can it happen, first of all? And then how do you do?
Anything can happen.
Obviously.
Right?
Yeah.
But to be able to bring down 50,000 nodes that are currently running the network, plus the mining networks globally, it's a virtually impossible task.
Okay.
Right? It's a virtually... Now, I'm not a computer science major, but... Thinking about it from a logical point of view, you need 50,000 points of attack plus all the miners, right? So you really need something to really break down. Now, power can go out, right? But if power can go out, how are people going to pay you if they don't have cash?
Anyways, indeed.
Right?
Okay.
So it's really like it diversifies the counterparty risks to, instead of one company, 50,000 nodes.
Exactly. And the way, a lot of what you hear is... It's an alternative. It's going to replace, and that's why I said I don't think it is going to replace. But it's a very nice complement if it's set up well and if the legislation allows for it.
Okay.
once again, everything in this episode is purely my opinion.
Yeah, definitely.
And not financial advice.
And not financial advice.
No, but that's super interesting to get how that could affect the corporate treasury landscape in the future. Anything else, Daniel? Let's be concluding.
No, guys, you've exhausted me.
Usually
You've
that's a good
exhausted
thing.
me. This has been great.
We need to rethink how we interview our guests.
That's the
They always
feedback we
say,
get.
"No, I'm exhausted."
This has been great. Yeah.
Thank you so
Awesome.
much,
Really,
Daniel.
really appreciate it.
Thanks a lot.